Well, hello, everybody, and welcome to this quarter's Market Outlook and Strategy webinar titled Back to Normal, Where Does the Market Stand After Its Big Recovery? My name is Jeff Porter, and as always, I'm joined by my colleagues, Gary Lyons and Walt Knockett.
Hello, everyone.
Hello, everybody.
Here's the agenda for today's presentation. It's not going to be an overly lengthy one or a complicated one because for the most part, we're going to be concentrating on the big picture. And for the clients who have been with us for a good number of years, you know that whenever we're talking big picture, we always go back to two things. One, the business cycle, and two, valuations. So we'll give you an update on those. Then we'll turn our attention to discuss a question that we're getting most often from clients, which is pretty much something along the lines of, have stocks gone up too much? And of course, the underlying questions there are, should we be reducing our equity allocations, or, hey, I got a lot of cash, should I wait for the market to pull back? Those type of questions. So we'll explore those. And lastly, we'll be talking a little bit more on inflation and interest rates. Now, Greg Sullivan and I, 2 months ago in our virtual summit, hit this topic pretty hard for about an hour. So we're not going to go into too much detail today. If you missed that summit presentation and you're interested in getting in the weeds in this topic, just notify your advisors and they can send you the replay link. So before we get into these topics, I think it's important to do one last quick look back at last year, really just to congratulate our clients for getting through a difficult period. You can see this is what the chart looked like at the very bottom in March of last year. And as we've mentioned a few times, it was unprecedented in terms of the speed of the decline. What was not abnormal, however, was the amount of previous returns that it took back. So you can see here that it pretty much took back all of 2017, 18, 19, and a little bit of 20s returns in one swoop. Again, that's not abnormal. You look at past recessionary downturns, and they generally steal back 3, 4, or even 5 years of returns. What also is not abnormal is how things resolve themselves, which is markets eventually recovering and getting to new highs. So this is the chart through the end of March, quite remarkable. And we get it, that when we're talking long-term, when we're talking buy and hold or stay disciplined, stick with your strategy, that's kind of boring talk. We get that. But, you look over the years, that long-term type of thinking has always rewarded investors, and it rewarded investors certainly once again. All right, so now we can turn our attention to the topics of this presentation, which again is the US economy and business cycle to start. And I think it's important, from an educational standpoint, when we're talking about the economy or really any other indicator, nothing is going to tell us what the market is going to do in the coming months. The market could go up 10% from here, it could go down 10%, it may go up 10% and then down 10%. We're not quite sure. But that doesn't take away from your ability to have an opinion about the market. So when you're starting that thought process, I think it's important to start with this chart, which we have shown in previous years, but it's a good one to revisit. What it shows in the gray bars are the annual returns for the S&P 500. These are calendar year returns. And the red dots are the maximum intra-year declines for the market. So for example, let's look at last year. There was an intra-year decline, peak to trough, of roughly 34%, but the market ended the year up 16%. More importantly, when you expand your lens here and take a look at the whole chart and the red dots, you'll see that there's a ton of down 7, 8, 9, 10, 11, 12 type of experiences pretty much every year. And if you were to do the math, the market tends to fall at least 10% every 11 or 12 months or so when you look at a rolling basis. So they are quite normal, and we would say that they are just the price of admission for investing. Nobody knows when they're going to happen. Nobody should try to time them. They just happen. And a great example of the market, doing what it wants, no matter what, is 1987. So if you look at, that year, the market was down 34%, just like last year. But in 1987, the economy was strong. There wasn't a recession in that year. It wasn't, close to a recession, and it still fell 34%. I will say, however, that the big declines, the down 30s, the down 40s, the down 50s, et cetera, usually happen in or around recessions. And that is the entire reason that we look at the business cycle. So let's get there and talk about that. So Gary, what's it looking like right now?
Yeah, so here the green line, Jeff, is the U.S. Leading Economic Indicators Index. And as we've talked about many times on these webinars, the leading indicators include things like durable goods orders, manufacturing orders, building permits, basically all the factors showing forward success for the U.S. economy. And as you can clearly see there, look at the spike on the green line inside the gold box there. The index is on track to have by far its fastest recovery ever. And that's really reflecting the rapid recovery in economic activity, not only last year, but also this year. And this strongest growth in decades is fueled by record levels of coordinated fiscal and monetary policy. And the Conference Board, which constructs this index, says that all segments of the U.S. economy, households, corporations, and government are synchronized for growth in a manner that's unusual this early in an economic cycle. Again, it looks like we are in the quickest and strongest recovery post-World War II.
So Gary, as this says, this is the United States Leading Economic Indicators. We know it's a big world out there. So what does the global economy look like?
Yeah, absolutely. So the blue line here is the Ned Davis Research Global Recession Probability Model. And it's showing only a 7.4% chance, the gold circle there, of a global recession. So very low global recession risk. And the model has had a good historical track record and plots the probability of recession based on leading indicators from 35 non-US countries. Now notice the horizontal dotted lines that break the chart into three zones: high, mid, and low recession risk. And the gray shaded bars show periods in which the Organization for Economic Cooperation and Development, the OECD, said there was a global recession, something that, by the way, is only known more than 6 months after the fact, because that's very often how long it takes to adjust and confirm all the economic data. Now, when the probability model is reading below 30, that lower dashed line, recession has occurred just 18% of the time. As confirmation to the Ned Davis Research Probability Model, the Conference Board also projects a return to pre-COVID highs for global growth this year, but says the recovery will be highly uneven, as we would expect, Jeff.
So Gary, you mentioned on the last slide that there's a lot of real kind of on the ground, hard economic data in not only this Ned Davis indicator, but also leading economic indicators such as building permits and jobless claims. But we know that sometimes it's the financial markets that can get into a bad period, and that will impact the real economy. So what does our financial system essentially look like right now?
Yeah, so the blue line here that we're looking at is the St. Louis Federal Reserve's Financial Stress Index, and it's measuring the degree of financial stress in the markets, and it's constructed from 18 weekly data series. 7 of them are interest rate series, 6 are yield curve spreads. Each one of the variables captures some aspect of financial stress, and all the data metrics are turned into a composite oscillator such that any reading below that 0 line for all the indicators means low financial stress, and any reading above the 0 line shows a higher level of financial stress in the economy. And as you can see there on the chart, all the way to the right, we have low financial stress, meaning lots of liquidity from the Federal Reserve. So the financial plumbing shows no warning signs. As many Fed watchers say, earnings don't move the overall markets the way the Fed and central banks focusing on liquidity move the markets. And in fact, liquidity really moves markets, as we've seen these last years. When trouble comes, it's usually because the Federal Reserve has hit the brakes, or at least that's been the case for every cycle over the last century. The Fed raised interest rates by 400 basis points before the Lehman crisis, 350 plus basis points before the dot-com bust in 2000, and over 1,300 points during Paul Volcker's war on inflation. So big money is made in the markets by being on the right side of major liquidity moves. And as we're always saying, it's suicidal to fight liquidity trends because they have a higher probability of continuing than not continuing.
Yeah, Gary, it gets back to the adage that we've been talking about for quite a few years now, really going back to the great financial crisis, but definitely since March of 2020 again, which is don't fight the Fed. And I think this next chart really sums it up well.
Absolutely, Walt. So here we see that in red, we see the growth of the S&P 500, and in blue, the very similar growth of 3 major central bank balance sheets, the Federal Reserve's, the European central banks, and the Bank of Japan. Central bank balance sheets have just surged since 2009, and they exploded higher around the world during the pandemic. Of course, all that unprecedented intervention, especially in the US economy during the pandemic, has spiked asset prices. And this has been happening globally. Central banks around the world have been printing money and using it to purchase assets in order to stimulate their respective economies. Just the world's 5 largest central banks had printed over 44 trillion in assets in the last 5 years as of mid-April. So for central banks, we don't think there's any alternatives to what they've been doing. And that support, in our view, will continue for a very long time.
So it's these indicators and others, out there that are pretty much showing a strong economic recovery at this point in time, with a nice handoff to an economic expansion, especially with the backing of the governments and central banks. So Gary, based off of that, what does that mean to, or historically, what has that meant to stock investors? Let's connect the dots there.
Yeah, so here we see what it's meant, and we know we're early in a new expansion, and here we see the odds of various S&P 500 one-year total returns during US economic expansions. And as you can see there, when we are in an economic expansion, the probability of a recession is very low. In fact, you see there the probability that returns are positive is 87%. Now, the probability that annual one-year returns are greater than 10% is 63%, and almost a third of the time, returns of 20% or higher. So we should continue to see a very low probability of recession, because a recession would most likely need a Federal Reserve tightening of monetary policy, not just a huge external shock as we saw last year with COVID. Current fiscal stimulus coupled with central banks' continued very accommodative monetary policy indicates that the trigger that's typically sparked a bear market, and again, that trigger is the tightening of monetary policy. It's just not present today. Further, it looks like there are few, if any, imbalances in the US economy following years of increased banking sector regulation like we've just had, Jeff.
Yeah, so as an investor, I think the left side of this chart is much more important than the right. You don't know whether it's going to be 10% or 20% gains, but the takeaway here is the probability of a big decline, the one that scares investors the most, is probably low. It's essentially saying that when this huge oil tanker of the United States is moving in one direction and gets some speed, it's very difficult to quickly turn around and go the other direction. And in this case, that would be a recession. So this should be comforting to investors. So, Walt, as I mentioned in the agenda, yes, this is comforting, but there's this question of, okay, has it gone up too much? Is it too high? Should we do anything about it? So let's explore that.
Yeah, absolutely, Jeff. And it gets back, it's one of our most frequently asked questions from clients these days. And it gets back to the second lens that we tend to view the markets through and make strategic investment decisions through. The first is where we are in the business cycle, which you and Gary just walked us through. We appear to be in the early stages of an expansion there with extreme accommodative support from both fiscal policy and monetary policy. But the second lens is valuations, or how cheap or inexpensive an asset class is, and essentially what price are investors willing to pay for the future stream of corporate earnings. And that brings us to this chart, which shows the price level of the S&P 500 in light blue. And we see on the left-hand scale the near 80% rally that it has had since March of 2020, the COVID lows. And then in the dark blue, we have the forward-looking 12-month estimates of corporate earnings per share for S&P 500 companies. And we've seen quite a significant rebound there. Back in March and April of 2020, one of the reasons why the market was so low and investors were so what seemed like depressed is analysts weren't expecting corporations to return to pre-COVID earnings power until 2024 or 2025, years out in advance. And already in 4Q of 2020, we saw corporations blow through that number, and corporate earnings are expected to grow at over 20%, maybe even 30% in 2021. And so that's what you're seeing in that rebound there. Now, the relationship between the two is interesting. This chart goes back to 2011, and you can see they're fairly tightly correlated, moving in the same direction, but also the gap between the price and the earnings usually doesn't get too large, especially in the size of the gap that we're seeing over the past 12 months. And a lot of this has been, talked about in the media. Have future returns been pulled ahead? And I think we're getting into a scenario here where it's letting the fundamentals catch up with the markets a bit. So there's a lot of different routes that this could take place for the two to converge. And I think what's important to note is these are two absolute components. The next chart that we're going to look at puts the two together into a common valuation metric. So this is the cyclically adjusted price to earnings ratio. And what this does is look over the past 10 years of corporate earnings and adjust it for inflation. So it's meant to smooth out the volatile earnings stream and make it more consistent over time. And what we can see on the right-hand side of this chart is that we're at about a 35x CAPE ratio today. And to put that in perspective, this chart goes back to the end of World War II. We've only been at that level or higher one other time, and that was in the late 1990s. Now, I want to caveat this with there's a lot of differences between today's market environment and the late 1990s. We've talked about a few, namely, what the Federal Reserve has done, but primarily it's interest rate levels, because interest rates play a really key role of what are investors willing to pay for that future stream of earnings. So, right now, another takeaway from this is when you look at the gray shaded areas, the recessions, it was very commonplace for the CAPE ratio to come down and to become more attractive after recessions. And what's been interesting about this is, given the 80% run in stocks, you can see that in March of 2020, the CAPE ratio got down to around 24 or 25x, but has since run right back up to what we would consider in this absolute metric historically expensive.
That's right. So you never want to disregard these tried and true fundamental measures and the price of the market relative to the fundamentals, like earnings that we're looking at here, the price of the market relative to sales or revenues, relative to cash flows, relative to GDP, and such. Those are all very important metrics, but you need to take it with a grain of salt if you're in a different period. So Walt, you mentioned, the low interest rate environments. That has to be factored in. Also, a number of slides ago, Gary showed how important it was to look at the balance sheets of the Federal Reserve and other central banks, and how the connection is there to the market. So the other day, I was looking at a few valuation metrics, some charts, comparing the price of the market relative to the balance sheet of the Federal Reserve. And if you look at those, it looks like a number of different asset classes are cheap. So we would not call this market cheap by any means, but it does show that you gotta look at the world where you are right now and adjust accordingly. So Walt, as you mentioned, your last comment here, the spike up, even though we're kind of in a recession and still coming out of it, you've had this major move in stocks. Valuations are much more expensive than you would normally have just coming out of a recession. So many people might think that, okay, that's it for the stock market's run. We've squeezed enough juice out of this orange. But that may not be the case if you look back in history, isn't that right?
Yeah, absolutely, Jeff. And I think, it's important to note here that we're looking at historical returns. So coming out of World War II, the median and average post-World War II gains from those relative bottoms have been 140% and just under 200% respectively for the S&P 500. And then if we go back on the far right hand of this chart, taking just the last 4 expansions, which have been longer than the average expansion, if we factor in all of the data going back to the 1920s and end of World War II, we've seen average gains or median gains of over 400%. So although this 80% gain seems like a lot in such a short period of time, these bull market cycles tend to last a long time and tend to have higher returns. So there's definitely potential for a more room to run scenario to play out here. And I think what we always are dealing with markets is tailwinds going up against headwinds. So undoubtedly, a headwind is some of these valuation metrics when you compare them historically. But I think it's important to note that one of the more important valuation metrics is how do stocks look relative to bonds? And given where interest rates are, stocks actually still look attractive relative to bonds on a lot of historical measures. And so here, I think when we get back and we view clients and their portfolios, what we always tend to say is you have enough staying power, enough dry powder built up in your covering your next 6 to 8 years that is in high quality bonds, that you shouldn't really worry about what's going to happen over the near term in stocks. You have that staying power to fight through it and to really take advantage of these types of returns. Because I think, as we've seen, if you only went by one metric, the CAPE ratio, it would have been telling you to take risk off the table or to be selling stocks in what has been a tremendous bull market over the past few years.
Well said. Thanks, Walt. You talked about bonds and relative to bonds. So one of the fears for investors right now revolves around inflation and interest rates. And as I mentioned, we hit this topic really hard 2 months ago. And the main takeaways were, one, interest rates are low. So that's generally going to mean lower returns for bonds and likely lower returns for other asset classes looking out over a very long time period. Let's say inflation does arise in the coming year or years or so. That would obviously be bad for bonds, and that may kind of hurt the party for other risk assets such as stock markets. Now, our base case is that it's going to be very difficult for inflation to really take off because of the structural issues that we spoke about in the previous presentation. But the risks, in our view, certainly have increased versus 3, 5, 10 years ago. But we don't know exactly where inflation is going to be in the next 6 months or the next year, and nobody does. I think this is a good, again, educational chart. What it does is show a study that was done a number of years ago by the Federal Reserve Bank of Philadelphia. And what they did is looked at the so-called professional forecasters of inflation and saw and looked at how accurate they were. So these bars, the higher the bars, essentially the higher the miss for these forecasters. The green bars show upside surprises. So when inflation is higher than their projection, the blue bars are downside surprises. So when inflation is lower than their forecast. So for example, in 1950, that says that inflation was 9% higher than these professionals were thinking that it was going to be. And I think the most important thing about this chart is the gray dotted line there that shows the average miss, which is 1.5%. So if we're thinking that inflation may come in at about 3% this year, well, it'd be perfectly normal for it to either come in at 4.5% or 1.5%, which would mean completely different things for the market. It would mean completely different things for central bank policy, and we know how important that is. So it's not about exactness or precision of predictions. It's just about weighing the odds and then making adjustments accordingly. So why do we care about inflation? Well, this shows why. This is a study that was done in 2010. It looked back at various inflation regimes all the way back to 1926. So when I say inflation regimes, I mean various levels of inflation, and then how US bonds and US stocks did relative to inflation. So over the past 10 years or so, we've been living in this low to moderate, kind of near the Fed target range of inflation. So call it around 0 to 2, 0 to 2.5%. And you can see historically, this has meant pretty darn good things for bonds and equities in the US. For example, in that moderate range, up 4.4% annually over inflation for bonds, up 12.4% annually over inflation for equities. And lo and behold, over the past 10 years since the study was done, same thing happened. Great returns for both bonds and equities. Now, historically, where you've kind of run into some trouble with returns is when inflation gets up to around 4% or thereabouts. That's the high level, and that's when you have seen US bonds struggle, negative 3.1%, and US equities struggle, only up 1.9% over inflation. And then, of course, when you get the crazy inflation over 10%, we had that in the early 1900s, in the 40s and 50s, and the 70s. That's when both US bonds and US equities really struggle and lose a lot of purchasing power to inflation. So another way of looking at this is through interest rates. So we know interest rates have been increasing recently. Usually when inflation is heating up, interest rates increase as well. But when you look back at the data at all the times where interest rates have been increasing, that generally means good things for stocks. On average, stocks have returned 17% annually in these periods where rates have been rising. And that's more than the longer term average of 10%. So that's reassuring. Now, once you see those interest rates start to increase more than 3% from its previous low, that's when you start to run into some problems. So let's take today's situation. We have the 10-year Treasury that bottomed out around 0.4, 0.5%. It's increased. It got up to about 1.75%, and now it's settled down to about 1.6%. So call it an increase of roughly 1 to 2.1 to 1.25% since its lows. So, yeah, is that an issue? Well, historically, it would say, no, it's not an issue. And it could even increase to 1.5%, 2% over that low. Who knows? Before it really hurts the party in equities. So again, not about prediction or precision there, but it seems like we're not in danger territory because of inflation or because of rising interest rates. So that's it for the topics of today. Let's take a look at the key takeaways. As always, one, having an opinion about the stock market is not about knowing how to predict things with precision. It's just weighing the risks and the rewards and the probabilities and then adjusting the portfolio accordingly. It's certainly not knowing or trying to predict when stock market corrections occur. They're completely normal. They happen even in great economic environments. They're just the price of admission for investors. Now, when we look at the big picture, clearly the big positive is the strong economic recovery. Looks like it's going to be a good handoff to an economic expansion. Most importantly, when you're out of a recession or the risks are low for a recession, the risks are also low for a major downturn. So that should be comforting for all investors. The major negative is the speed of the recovery, which has made stocks look expensive by many measures, but those should be adjusted for the world that we live in right now. And even if stocks were truly expensive on every metric, it doesn't necessarily mean that they're doomed to fail in the coming months or even years. We talked about inflation, and while nobody knows exactly what's going to happen with inflation, risks, in our opinion, have risen. So that could lead to higher interest rates. But the good thing is higher interest rates have been a good thing for stocks because it usually signals a recovery in the economy. And it's only when they get too high as that generally hurt returns. And we just don't think we're there yet. So those are the main topics and main key takeaways. Thank you very much for the time. We appreciate it as always.
So thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Walt, call your service team if you need to discuss anything, or if you just want to comment or just have a question. We always enjoy hearing from you.